What we're going to talk about in today's video is health ratings on whole life insurance policies. We often receive the question, if I'm not healthy, can I still qualify for a policy? Or, I'm not that healthy right now. There's a couple things over here I'm working on. I think I'd prefer to wait until I'm healthy when I can get a preferred rating and then I'll start a policy. Is that necessary? Or can it potentially make sense to start a policy now? So what we're going to go through today is information on health ratings, the different ratings that are available with life insurance companies, and how they can impact the policy if you're looking to A, just purchase a policy for death benefit, if you're looking at price quoting it, and then B, if you're looking to maximize the cash value of a policy, how will a health rating impact your cash value performance? So, to begin, here's what we've got. With a whole life insurance policy, you've got many different health rating categories. And I shouldn't just say whole life policy. This is the case with life insurance policies in general. But if we just look at some of the standard categories, here's what we have. So we have the three most popular: ultra preferred, which is the top health rating class. With every company, it's not going to be called ultra preferred. Some companies say super preferred, some companies say preferred plus, but it's the top health rating class. What it means is the insurance company views you as very healthy. They also have potentially looked into your family health history. They see that your family health history, there's a lot of longevity there, no extensive cancer history or heart disease history that is. You're very healthy and they view you as a very favorable risk. So you receive the top rating, which means you have the lowest insurance expenses within that policy that are possibly available. Then we've got a preferred rating, which is the second best class. Often this is called preferred or regular preferred, but this is the second best class. And then we see standard non-smoker. Sometimes we'll just see a standard rating, and this is what the majority of people do receive when you just look at things from a statistical standpoint. But I'll say all of these ratings are fairly similar. We're going to look at some comparisons, but these are your three main classes. Now, the next class down, we've got rated, number 4, extra premium. So what a rating represents is that the insurance company views a health issue you have as a higher concern. Therefore, they are going to assess additional premium or additional expenses with your policy. So if you're price quoting it, you're just buying a policy for death benefit and you receive a table rating, you're going to pay more for that death benefit than someone with a standard rating, preferred or ultra preferred rating would, significantly more. If you're interested in a high cash value design and you receive a table rating, then what will happen is your cash value will perform at a lower level than what it would if you had received a standard non-smoker rating or a preferred rating. And again, we'll look at some comparisons here. And then lastly, we've got tobacco rating, which is if you use tobacco, you'll likely receive a tobacco rating, and that will really increase the premium, or it will result in poor cash value performance. We'll look at a comparison there. A little bit more on table ratings actually, because I kind of brushed over this. We see table A and then class 1. These mean the same thing. Some companies will use letters where other companies will use numbers, but if you see a table A with one company and a class 1 with another company, they mean the same thing. Same thing if I look at a table D compared to a class 4, that's the same rating, the same category where the insurance company is going to assess some additional expenses and charges. Let's provide some details on that actually, because that's important. So when we look at table ratings, here we go. So first we'll go through some of the reasons why insurance companies assess them, what they mean for the company and for you. So we've got some bullet points here. If we look at the second one, this is from an insurance company. What do we see? The necessary extra premium to cover the excess mortality is dependent on the age of the proposed insured as well as the plan. The plan refers to the plan of life insurance. For example, if you were looking at a whole life policy or a term policy, you may receive a note from underwriting that with a whole life policy, they will offer a standard non-smoker rating. However, all other products, such as term or universal life, will receive a table 4 rating or something like that. So you will see that does depend on the company, but that's why they have in there the plan. Next, we see premiums are calculated based on the percentage of mortality risk in excess of the standard mortality risk. Fun verbiage, isn't it? Here we go. So if we look down here, we have the different rating classes. Table A, excess mortality charge, 25%, meaning 25% more than what a standard non-smoker rating would be. How about a table D, 100% more? What happens when you continue to scroll down? It gets very, very expensive. Table ratings occur if you have a severe health issue, or maybe you have several minor health issues where the insurance company views it as a risk. In our experience, if someone has high cholesterol, but it's always been well controlled, they've always been compliant with their medication or their doctor's notes and such, that typically does not result in a table rating. With high cholesterol, we even had cases where individuals have received preferred. However, if someone has high cholesterol, high blood pressure, their A1C levels are high, which could result in diabetes, that's early signs. Maybe they're a little overweight. They've got several factors where the insurance company looks at them and says, man, like they've got several small issues here which can quickly escalate and turn into a large issue. With everything they've got going on, we may view them as a higher risk of heart disease or something like that, especially if it's in the family. So it's rarely one thing from as far as a minor issue is concerned that will result in a table rating. But if someone has several health issues, that can sometimes result in a table rating. A lot of times it could still result in a non-smoker rating though, which is nice. Now, if you had cancer in the past, perhaps you overcame it, you're now cancer-free, but it was within the past 5 or sometimes 10 years, it will depend on the type of cancer. But if you've recently overcome cancer, the insurance company will likely assess a rating or even temporarily decline you until you're 5 or 10 years cancer-free. And again, it does depend on the type of cancer. Take that statement I just made with a grain of salt, or it's very, very vague. Why I say that is if someone had skin cancer and it was not barely stage 1, they cut it off right away, no issue whatsoever, that we've had cases where people still get preferred. You're even eligible for ultra preferred. Like that, you caught it early, it's a non-issue. If it's something that's serious and life-threatening, or it was in the latter stages and you overcame it, that's where the insurance company wants to make sure it does not come back. But just a little bit of information on that. We can talk about so many different health conditions and how they can impact the potential rating of a policy. If you do have questions about that, feel free to let us know. You can email our office if you're working with any of our associates or working with our team already. Definitely ask. We do have a quick guide we often like to refer to that just lists out different health conditions and how insurance companies view them and what rating they may give. It's never, here's exactly what you will get, because they are going to review medical records. But if you're just trying to find out, hey, can this impact me? We can always give you some information on that as far as how companies generally view certain health conditions and such. There's a lot to underwriting when you look at it. But with all that said, what does all this mean? And here's the question that often comes up. If I'm interested in a policy for high cash value, how does it impact the cash value of the policy? What's the best way to determine the additional cost? What I like is to compare illustrations. An example, what if I look at a standard non-smoker rating compared to a table rating? What's the difference there? Well, let's take a look, shall we? We will have some fun here. First, we'll look at price quoting. We'll look at a $1 million policy, and what you'll see is this trend. If I have a less favorable rating, I'm going to pay a higher premium for that $1 million death benefit. If I have a more favorable rating, such as ultra preferred, well, I'm going to pay a lower premium for that same $1 million death benefit. And then we'll look at designing a policy for high cash value. What this involves is you saying, I don't want a certain death benefit. Here's how much I want to pay in. Say it's $10,000 per year. And that policy is designed where we've got the premium at the minimum or very close to it at $1,000. We're allocating $9,000 per year toward PUAs, a 10/90 split, maximum cash value. The rating will have an impact on the cash value performance and the death benefit performance, because the cash value and death benefit work hand in hand as time passes. Let's take a look. So I ran 2 companies here for this comparison. Let's look at the top 3 categories first. What do we see here? And this is a $1 million price quote. That's what we're looking at. We've got the top 3 classes: preferred plus, which would be ultra preferred on the left, regular preferred in the middle, and then non-smoker on the right. Now, one thing I'll add about this, because this is with Guardian, they actually treat their preferred and preferred plus the same in terms of the base premium cost for a whole life death benefit. So here we quoted a $1 million whole life insurance death benefit. Got preferred, and then preferred plus on the left. What's your premium? They're identical. What's your cash value in the first year? They're identical because the base premium is identical. How about the next year? What do you notice? Slightly stronger. $24,850 compared to $24,830, $20. So we can look at things over time. And by the way, this is a price quote. So if you're interested in cash value, this is like the worst type of design. This will not generate strong cash value. This is 100% base premium design. But as we look at it, let's look at year 20, shall we? He's paid in $469,000. Cash value is $582. With the preferred rating, paid in the same amount, cash value is $577. Is there a big difference between those two over 20 years? No, there isn't. Even when you look at the death benefit, it's $8,000. So preferred to preferred plus is not always a huge gap there, which is nice. How about non-smoker? What do you notice about the premium? Is it the same? No, it's higher. How much higher? $1,000 higher. So we do pay a little bit more for the non-smoker rating. Extra $1,000 is paid. What's your first year cash value? Still $830. What's the next year though? $2569, $690. That's higher than the 2 to the left. Why it's higher is because we're paying an extra $1,000 per year. So the non-smoker policy here, you see more cash value and death benefit just when we look at the numbers on the surface, but do you really have more? What I mean when I say, do you really have more? Because if you just look at it on the surface, yeah, I got more. $592 is more than $577. However, how much more did you pay in? $492 over here, you paid in $469. And then what's the difference in cash value? See where I'm going there? And you can actually run that math quick. Let's look at year 20. How much more did I pay in at year 20? $23,000. Then how much more or less do I have in cash value? I've got $14,000, call it $15,000 more in cash value. So what that means is the non-smoker rated policy actually has $8,600 less than the preferred policy, because we got to take into account that this guy was billed more money. And this is just based on a 45-year-old male with a $1 million policy. So you'll see that trend with the top 3 ratings, but what happens when we make it a table rating? So we've got class 2 and class 4, which would be a table B and then a table D, non-smoker on the left. What happens when you look at the premiums? They jump, don't they? Now, with table ratings, what's different about this? Look at year 20. The non-smoker rated policy, where you paid less, has more in it. What I'll also add about the table rating, so this is with Guardian here, we see after year 20, it drops to the non-smoker rating. Premium, that is, non-smoker rated premium. It's the extra premium for 20 years in this case. But that's a lot of extra when you look at it. And again, this is price quoting. Let's look at very quickly. Tobacco versus non-tobacco. Tobacco raises the premium quite a bit when we look at it. An extra $6,000 per year. So that's price quoting. Let's now look at the fun stuff, the high cash value, baby. So designing a policy for high cash value, We use some round numbers here of 100K per year. Here we go. What do you notice? On the left, preferred plus. On the right, preferred. From a funding standpoint, these will be identical. From a death benefit standpoint, we're using term insurance riders to target the death benefit we want. So my favorite part about this is we can now take these two policies and see if I keep everything equal, I reverse engineer the policy and set it up for maximum cash value. Again, keep it equal. What's the net difference in cash value? So I can see it as a consumer. CV difference. What color would you like that? Purple? Color of royalty. First year, $81 difference, which is going to be about the difference in the term insurance cost. If we scroll all the way down, what do you notice? By year 20, $9,000 difference. You've paid in 500 grand, and by 20 years, right, after a full 20 years, the total difference is $9,000. You can look at the same thing with a death benefit if you'd like, because that is impacted. Call it DB difference. And there you go. You can do the same thing. There we go. Actually, I did that in reverse order. My bad. So now we see how much more we've got in life insurance with the preferred plus rating. Then you can do the same thing as we look at regular preferred compared to non-smoker. There you go. And then if we look at non-smoker compared to tobacco, it's substantial as time passes. And then you can do the same thing with class ratings. Table ratings is typically where we like to do this. So we can see firsthand what's the true difference in cash value performance, class 4. And here's what I'll add about this, because we do get individuals that have health issues, but they want to start a policy and they don't have anyone else that can put a policy on. They say, man, like, can I still start it? The answer is yes. How I just view this is if we flip positions and I receive a table rating, what I would appreciate, this is me personally, is just seeing how much extra does it cost, just so I have awareness. And we see that by looking at a side-by-side. Then, from an awareness standpoint, many people are not aware of this, you can actually upgrade the health rating. So if you've got a health issue that you solve or you fix as the years pass, you can actually improve the health rating of an existing policy. You have to go through a new medical exam. The company will order medical records. But we've had people do this. Remember one case, an individual had a policy for several years. He received non-smoker because he was a little bit heavier. He got into running, lost a lot of weight, applied to upgrade the health rating on his policy, got ultra preferred, so jumped up 2 classes. And what happened is that his premium was repriced, his cash value jumped up. But when that's repriced and re-rated, is it based on the date several years later that he goes through that exam? No, it goes back to day 1, his policy date. So he gets a nice little jump from day 1 up through his current policy year. So it's a nice option to be aware of to save time. We do have to improve our health to qualify for it, but it is a nice feature that it's like, oh, I didn't know that. All right, I want to move forward now because I'm going to overcome this. But my point is, information helps. I hope you enjoyed this one. If you did, please let us know. Leave any questions or comments below. And as always, I hope this helps. Thank you so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.